3 stocks to buy in May 2019. Yep, it's another classic 3 stocks video that pretty much every YouTuber does, every finance YouTuber. But here we do it a little bit different. Yeah, we get a little twist to it. Because if you've been with me for a while, you know I don't really care about stock picks. They're a dime a dozen. They don't matter that much. Like if you think about trading overall, picking a stock is like 10% of the process. The other 90% is actually managing your position once you're in it. But these damn 3 stock videos, it's all about like, okay, what's the hottest stock to get into? I'm not really about that. Instead, what we do is go over my portfolio that I share with the Fallible community. And I use a system called the Nasdaq All Stars. And that system is a momentum system. So what it does is it ranks all the stocks in the Nasdaq 100 by their momentum. It spits out a little number called the TSI. So the higher the TSI number, the more momentum a stock has. And what we do with the system is rotate into the top 5 highest momentum stocks. So the stocks that are moving, that's what we're getting into. And the stocks that stop moving, we jump out. And I explain more about that system in this video that I'll link to right here. So if you're interested in learning more, go check that out. But as we're going through this video, all these stocks fit into that system. So the first stock we got to talk about is Workday. We've been in this guy for a long time. And since then, you can see we made a nice over 20% return right here on it. Now with our system, we have certain rules in place. So when the stock climbs a certain percentage, we take some profits off. And we have 3 targets that we look for. So the first target on Workday was hit right here in February 25th. And right around here is where the stock was up about 20%. And at that point, we took off 25% of our position. So we sold 1/4 of our position. And that's important because as the stock is going higher, you want to lock in some of your gains. Because otherwise it's all just paper profits. The stock could turn around and you lose all that money. If you actually sell your shares and lock in the profit, it's safe in cash. So that's just a good trade management principle. Now what's funny is that you can see here, as soon as we took profits, the stock pretty much stalled out. So the last time we released one of these 3 stock videos was March 25th right here. You can see in this entire time, the thing has just been basing, just consolidating close to its 50-day moving average, which is this yellow line right here. And there's a few interesting things about this. The first being that it started basing at 20%. If you read the book, How to Make Money in Stocks, it's like the Bible for growth stock investing. I talked about it in this video here with 5 books I recommend. Well, the thing that the author William O'Neill talks about is how a growth stock will usually shoot 20% before it starts basing again. And when I talk about basing, I'm talking about the consolidation. It starts going sideways for a bit. And obviously this doesn't always happen, but it's weird how often it does happen, which is one of the reasons we take profits off on our positions when something is hit 20%. Not just because William O'Neill said it, but when we back tested our system, that seemed to work out the best. So that's a good kind of rule of thumb, at least with growth stocks, that you could potentially use in your own strategy. And another thing that's interesting is how nicely it coiled right next to this 50-day moving average. When you get a convergence of 2 types of technical patterns, here we have a consolidation and we also have the moving average, you kind of get a nice little risk area. So you could set your risk point here and enter right around here. So that keeps your risk low while increasing the probability that the stock moves higher. Because when stock coils like this, I mean, it's either going to break up or down or continue coiling. In this case, it looks like it broke higher. So this is a decent entry point for a discretionary person anyway. As I said before, I've been in this for a while. Now, the nice thing with having a system is that I was able to wait through all of this. Like, this thing hasn't moved for over a month. Now, when I was discretionary and didn't have a system to follow, waiting this long would kill me. I would have probably gotten out. I would have thought the stock was dead. I'm done, I'm out. And that decision would have been based off emotion, which is stupid. But with a system, there's actually logic that kept me in. And the other problem I found with discretionary trading is that I had to look at the market just too much. I had to look at it every day. With this system I'm using now, I barely look at the market, to be honest. And I know people hear that and they're like, AK, what the hell? You're supposed to be a stock market expert and you're not even looking at stocks. So they'll text me like, oh, did you see Facebook pop off? And I'm like, no, I didn't. And they might think I'm crazy, but honestly, it is great for me because when I stare at charts too much, I always end up wanting to trade. Like, you look at something too long and you start finding stuff. And normally when you're looking for that long, it's not the best opportunity. It's just your brain focusing on it too much to the point where you just start convincing yourself. And that's what used to happen to me when I was discretionary. And I would end up over trading, taking trades I wasn't supposed to. So not only was it bad for my P&L, but also staring at the market all day, every day, it just makes you crazy. Like, you know how phones make people crazy with all the notifications, right? Well, before phones, before all these apps, you always had the market to look at. It's like the original version of that. Little green and red flashing symbols, of course, is going to keep your attention and keep you glued to the screen. It's not good for you. Now, of course, it depends on your strategy. If you're a day trader, you're gonna have to spend a lot more time in front of the screen than someone like me. That's why I have a longer term strategy. It just works better for my personality. So I really don't have to check the markets more than once a week. And it's also good for me because I could focus on this YouTube channel and the other stuff I'm doing. I don't have to be staring at the markets. And fortunately, with what I'm doing, I still get my trading fix because I love trading, right? So at least I'm talking about it all the time, every day with you guys. But talking about it and talking about process and stuff and focusing on that is not the same as trading, which is a good thing. So the best traders and investors, they're not looking at charts all day either. They're off studying, focusing on their process, coming up with new strategies, but not just staring at the screen like a junkie. And hopefully you can use this channel and these videos we make the same way, like jumping down in the comments, talking to people, talking about investing and learning more and working on your process, but not getting stuck in front of the screen. But anyway, it looks like the sitting and waiting is about to pay off. And if we look at Workday, it's still number 7 on the momentum list. It hasn't moved since last month. The momentum is still decent in it at the TSI rating of 17. So we'll likely stay in it going into next month, because in a few days, depending on when this video is released, we're going to rotate our positions. We want to stay in the highest momentum stocks, right? So based on Workday's number 7 rating, we're going to stay in it, most likely. I mean, I don't know what's going to happen in the next few days. Next stock is Xilinx. And you can already see we had a pretty nasty earnings call right here. They actually beat estimates and the stock tanked pretty hard anyway. That's over a 17% drop in a day. That is rough. But if you've been watching our videos this series, then you know that we got into Xilinx way back here, November 1st here. And you can see that this thing has just been a monster winner for us. It was up over 60% by that point. And by the way, if you want to see those previous videos we made in this series, just check out this playlist right here. So you can kind of see how we've been managing these positions month after month. It'll give you insight into how you can manage your own portfolio. Now with Xilinx, we actually did something discretionary. We did something the system didn't tell us to do. And let me tell you why. So right here, April 24th, this was the day before earnings. And at this point, Xilinx was very, very close to hitting its third target. I told you we have 3 targets for all these stocks, and we take a percentage of our position off when each target is hit. So Xilinx was running for so long, it was about to hit its third target. The third target was at 142, right around here. And you can see with this little candle wick, it was almost there. So it didn't quite hit it, but it was about to. And we knew that earnings were the next day. And the thing with earnings, they're wild. You never know what's going to happen. The stock could jump a bunch, or it could fall hard, just like Xilinx did. Remember, like over 17%, real tough. So in that case, we were so close to the target that we decided, you know what, let's just take the profits. So we cut half our position. And I know I'm always talking about don't be discretionary, always follow the system, but there are a few cases where you're really close to a target and your risk to reward ratio actually changes, because there's a lot more risk holding through earnings than taking those profits right then. And we're only talking about a few cents difference. So we sent out the alert to all our members that are following this thing, and we took our profits. And it worked out for us because the thing collapsed. Now, when we take profits, we also move our stops up. We move up our risk point. So we moved our risk point up to 116.22. And you can see this candle just about hit it. Well, I mean, it did hit it, and we took off the rest of our position, but you can see it bounced right there too. So will the stock come back from here? Maybe, but I'm not going to beat myself up over it if it does rebound back, because I did the right thing. I executed the system. I used risk control and took the rest of the position off. And this example right here is why I say trade management is just so much more important than the actual picking of a stock. Because sure, this stock that we had, you know, it ran for a long time. We made a lot of money off of it, but it's in these instances where you can lose a lot of that money that you gained. We saved a bunch more money by taking those profits. And earnings for growth stocks are especially dangerous because growth stocks are shooting higher and higher, right? They have a lot of sentiment backing them. But if investors don't like our earnings report, it's kind of a double-edged sword, because as fast as it went up, it'll go even faster down. And when you see a miss like this, actually they didn't even miss, they beat. But when you see a reaction like this, it kind of shows that the momentum might be leaving this stock. The sentiment is turning against the company. So it could very well be dead money for a while. Because I mean, look how the other earnings reports worked out. Jump here, big jump here too, big jump back here. When you finally see the fall, that's a signal. It's like an inflection point. And it all has to do with expectations in the market, because fundamentals, technicals, they matter, but at the same time, they don't matter. What really matters is how investors look at those things. And you see it all boiled into the price. Whatever the price is doing, that's what you should be watching. That's why I use a momentum system. All boils down to price. Now, Xilinx, it's still number 6 on our list. It's still above Workday somehow. So it still has momentum of 17 again. So it might continue to do fine, like I was saying, but we're out of it. So that money that we pulled out of Xilinx, we're going to rotate that into a new stock. And the new stock will come from the top of the list. Well, it won't be MELI because we're already in that, but it will likely be Qualcomm. And that's what we do. Each month we rotate into the highest performers. That way our money is always moving higher, theoretically, and the stocks that stop moving, we're out of them. So we'll be doing that May 1st. Now the last stock I want to talk about is MELI, Mercado Libre. This stock we entered right here on March 1st. And you can see since that time we've made a little bit over 6% on it. And this was a stock, if you remember, we were replacing Starbucks and we got into Mercado Libre. We went over that in that last video. And back then MELI was number 2 on our TSI list. And now you can see it has moved up to 1 with a TSI of almost 27. And again, the TSI just tells you how strong the momentum is in that stock. So Mercado Libre, they have earnings in just a few days. So that's going to kind of determine what we do here. And actually sometimes when earnings are right near the first of the month, we might actually wait to rotate so we see what that stock does. Because you can kind of see this is the same situation that Xilinx was kind of facing. You got price coiling and running into its 50-day moving average with earnings coming up. With Xilinx, it didn't work out so well. With MELI, maybe it will. Now what usually happens, because we're in these high momentum stocks, is that earnings usually comes in the favor of the stock. Because if a stock already has high momentum, it means that investors are really liking it has good sentiment backing it. And it's weird, but that sentiment actually fuels how that earnings report is read. So if investors are already positive, they're going to look at the new earnings as positive too. And when that happens, you see the big jump. Now, when something like Xilinx, which was the example before this, has run so far already, that's when sentiment kind of starts to change. And you'll see the opposite happen. Investors won't be as positive, the thing can drop. And that also happens because as a stock keeps running, expectations keep building higher and higher and higher. So it becomes tougher and tougher for the stock to meet those expectations. And as soon as you don't meet investors' expectations a little bit, like I was saying, especially in growth stocks, you get knocked down hard. So we'll see what happens here. Now, if I was a discretionary trader and I had a solid opinion about Mercado Libre's earnings, maybe I would get in right here before, because I have this little support area right here. Now, some people do this, but in my opinion, it's kind of stupid because you never know what's going to happen with earnings. So if I was being smart when I was discretionary, I would just wait again to see what earnings did. And if earnings were good, you would probably see a pop off this 50-day moving average line. And then that's where you can get in, setting your risk point right around here. But everyone has their own strategy. They got to do what they got to do, right? If you're interested in learning more about the strategy I'm talking about here in the momentum system, which works out pretty well for me, then you could check out that video I mentioned before. It's right here. And if you like this video and want to learn more about trading and process and how we do it, then subscribe to this channel and hit that notification bell so you get an email notification when our new videos come out. We're publishing every single day, 7 days a week. Subscribe and come hang out with us. I will see you in the next video. Stay fallible out there. Bye.